Hey guys, Jeremy Parvin here. Welcome back to my channel. As you know, I've created a passive income stream of over $50,000 a month with rental income, and my portfolio is worth over $6.5 million. I've done this while working a full-time job, and on my channel I'm going to show you how you can do it too. So it's tax time, and I wanted to do a little coverage on some tax tips, and I also want to cover some general tax advantages that real estate provides for real estate investors. But before we get into real estate specific taxes, I wanted to touch on the third stimulus package, and I had a couple of tips there that I wanted to share with folks. There's a lot of news on the $1,400 check is on a lot of people's mind. It's my understanding that those could be sent out and received by folks as early as the end of March or in April. The thing that I wanted to mention to people is if you haven't filed your taxes yet and you qualified for these last year but you won't this year, you may want to wait to file your taxes, because if you get the stimulus check and you go ahead and file and don't qualify, you don't have to give it back. But if you qualified in 2019 but won't in 2020 and you go ahead and do your taxes, you won't receive the incentive checks. So hold off. You could even, if you can't make it through April 15th, you could extend the filing of your taxes. Or vice versa, if you didn't qualify for the current stimulus check with your 2019 income, but you will with your 2020 income, I would encourage you to go ahead and file your taxes as soon as possible. And if you happen to miss this stimulus check, there should be a way for you to file an amended return, and you can basically get that stimulus check money back as a credit on your income tax return, and you'll get it in the form of a refund check. And that's true for 2020 taxes. And then also going back to 2018 and 2019, there are approximately 8 million taxpayers that qualified for these stimulus checks that didn't receive them. And those are due to a few different reasons. Some people didn't file their tax returns, and so the IRS isn't able to see what their income was. Some people didn't use direct deposit and they haven't been able to kind of find, locate, or get the address and those sorts of things. And so those tax years and those stimulus checks are also still available. You can get those through filing your tax returns and claiming on there that you did not receive those and getting them back in the form of a refund check. So the $1,400 is for individuals up to $75,000 a year and couples up to $150,000 a year. It also extends the $300 a week unemployment benefits through September. And the most important part of the stimulus package and refund checks. Lily just wanted to say hello and ask you guys, if you like this video, please hit the like button so the YouTube algorithm can share this with others. Lily is going to give one pair of Apple AirPod Pros to one of our first 1,000 subscribers. Okay, so now for the real estate part of the tax update. So first of all, the tax code incentivizes people to invest in America, to invest in rental property and provide affordable housing to the public, and to take a chance, with your hard-earned money to build this great country and take a risk and to provide jobs. So one of the things I want to cover quickly is the concept of depreciation. And basically, if you buy an investment property or a rental house, if you had a $125,000 house, then you would subtract the amount of the land, and let's just say the land is worth $25,000, and so the house itself is worth $100,000. That would be depreciated on your tax return over 27.5 years, and so that math would be $36,000 a year that you would get to write off on your taxes as if you had spent that money on your rental property and you didn't. That will give you a free cash flow per year of that $3,600 without having to pay taxes on that. And that breaks down on a monthly basis to about a $303 monthly positive cash flow that you don't have to pay taxes on. So that's a pretty cool feature of rental property in general. Another really cool tax tip of real estate is that if you sell your primary residence and you make a profit on it, that would be considered a capital gain. You don't have to pay taxes on the first $250,000 for an individual or $500,000 for a couple on your primary residence, as long as you've lived in it 2 of the past 5 years. That is a huge tax benefit to not have to pay any taxes on that. And this is one of the strategies that I stress in my earlier videos about how to do your first rental property, and the home you live in being one of the best investment properties and a great way to get started. And repeating that, buy a house, live in it, get the great interest rates, and live in it for a year or two and then move to another one. That is a fantastic strategy if you want to sell those and not pay taxes, or if you want to hold them long term and just continue to build wealth and take advantage of that excellent loan you can get on there. Either of those strategies would work great. I sold a house that I lived in one time for about $300,000 more than I paid for it. The next thing I want to cover a little bit is just about the different tax rates, the tax table, tax brackets, the difference between ordinary income and capital gains, short-term and long-term, and effective tax rates. Those were a lot of words, but to try to simplify this, if you just look at the tax bracket that you're in from the money that you make at your day job, the average household income in 2020 was $88,000 a year. Is going to be in this 22% tax bracket. That's basically the maximum rate of taxes that family would pay. The first $20,000 would basically be taxed at 10%, and then the $20,000 to $80,000 would be taxed at 12%, and then just the last $8,000 would be at the 22%. And so there'd be very low effective tax rate, you call it. And that's really just, if you look at how much taxes you pay based on how much you earned, that simple math would be your effective tax rate. And then your marginal rate is just the last dollar earned. If you made a profit on a house that you sold or some stock that you sold, that would be called your marginal rate. And in this example, it would be the 22%. So if you make $1 more, it's going to be charged 22% tax. And so my point I want to make here is that on your earned income and ordinary income, your tax rates are some of the highest rates in the tax code, as opposed to capital gains. Capital gains are for the sale of assets, like investment properties or stocks, for example. And within capital gains, they're divided into short-term gains and long-term gains, and that's just less than a year or more than a year. If you have a short-term capital gain on the sale of a rental property or a stock, then it's simply going to be taxed at your ordinary or earned income rate that we just looked at in that table. But if you hold it for more than a year, it's only going to be 0, 15, or 20%. So back to our example of the median household income of $88,000, if you look at the long-term tax, if they sold a house and made $20,000 profit, for example, or sold some stocks and made a $20,000 profit, how much more income tax would they owe on the sale of that long-term capital gain? Well, married filing jointly up to the first $80,000 of earned income from their day job, their first $80,000 of capital gains will be taxed at a rate of 0, which is amazing. And then between 80 and 496,000 of earned income, they're only going to be taxed at the 15% rate. And if you remember, their marginal rate was 22%. And so if they had earned any additional ordinary income, it would be taxed at that 22% rate instead of this 0% or 15%. So basically, the rich make money on owning and selling things and not on earning it. The tax code is created to incentivize people to take those risks, to invest, and to grow our economy. And they're rewarded by lower tax breaks on taking that risk. Next, I want to talk about retirement accounts and brokerage accounts. These are important to real estate investors because they will help you to qualify for the loans to buy additional properties. When you fill out your application with the bank, they're going to want to see some liquid assets like this, and it's just another multiple stream of income for you as an investor to have in your portfolio, as well as diversify. You don't want to have all your eggs in one basket and just have real estate. If, for example, during this COVID 2020, if your income has dropped significantly due to losing your job from COVID, and you happen to have some 401k or IRA money, and your income that you report on your taxes for the year is much lower than it has been in the past, this is a great opportunity for you to consider transferring some of it out of those tax favorable accounts. That money has not been taxed yet, it's been tax deferred, and you can transfer it out of those tax deferred accounts into a Roth IRA that you can open up. And when you do that, it will cause you to have to pay taxes on that in that year, but you'll be taxed at a much lower rate since your income is low for that year, and you can take advantage of the early part of the tax table where there's only a 10 or a 15% tax rate during this time when you have very little income. If you think when you reach retirement age that you may be in a higher tax bracket. I did this over a few years when I transitioned out of corporate. It's very easy to do. All you do is call up whoever you have a brokerage account with now, or you can transfer your account, say, from a former employer 401k into an IRA. I personally use TD Ameritrade. I like them, and I like to have all my accounts in one place if possible. A lot of times you cannot do that with your current employer. With TD Ameritrade, I have a regular taxable brokerage account, I have a IRA with them, and I have a Roth IRA. If you leave employers, I encourage you to transfer that retirement account either into your new employer's retirement account or over into a Roth IRA, just to try to keep all your stuff in kind of one or two places. The other tax tip I'd like to mention is a Roth IRA contribution. Currently, you can contribute up to $6,000 a year, or I think it's $7,000 a year if you're over 50. And the difference with a Roth, as a lot of you already know, is it's something you do pay taxes on now, but you never have to pay taxes on the future. And the beauty of that is that it can compound, and those dollars that make dollars can continue to grow and grow, and you're never taxed on this again in the future. This is just another great multiple stream of income that you can use, and this single stream of income can very easily turn into $1 million by retirement age. You do have until April 15th of this year and every year to do it for the previous year if you've not yet filed your taxes. You can wait until you file your taxes. That's what I do. Or you can set it up on your bill pay to send even installments every time you get paid. So if you're going to do the maximum of $6,000 divided by 26 pay periods, for example, if you get paid every 2 weeks, that would be $230 every time you get paid. Now, if that's too much for you, what I do encourage everybody to do, and I encourage my sons, just get started. What can you afford every time you get paid? Can you afford $20 every time you get paid? I think most people probably can. What I suggest is you simply put that in your bill pay, use your bank's bill pay, and all you need is your account number from your brokerage account and the address. It'll be on your statement, and you simply send it in there every time you get paid like clockwork. Automation is a fantastic way to organize your life and your finances. Oh, here's one I really like. There's a loophole that if you earn too much and don't qualify to be able to do this, it's called a backdoor Roth IRA contribution. All you have to do is have a regular IRA. If you don't have one, you can set one up at TD Ameritrade or brokerage firm of your choice and make a contribution into your traditional IRA, or maybe you have money sitting there, and you simply make a transfer of up to $6,000 a year from your IRA into your Roth IRA, and that's it. I did this last week, and it's so cool to figure out these loopholes. Another tax tip I want to give you is about investing in the stock market. When you make your risky investments in the stock market, you should do those in a taxable regular brokerage account. That way, if you make some losses, which we all do when we buy individual stocks, you can use those losses against other gains to offset how much taxes you'll have on them. You can also deduct up to $3,000 of those losses against your income annually and carry forward any additional losses into the future. And TurboTax takes care of this for you and remembers it, by the way, which is really cool. And so you want to use your tax sheltered accounts like your IRA, 401k, and Roth to do your less risky investments in there. I tell all my friends and family just to buy an S&P 500 index fund. The one that I buy personally is the Fidelity S&P 500 index fund. The ticker symbol is FXAIX. And one last thing that you can do with your stock portfolio in your taxable account is at the end of the year, you can take some losses and sell some stocks that are dogs in your portfolio, and you can use those losses to offset some gains that you made in the year on either some stock or some rental property sales to save you from paying some taxes. And then in January, you could rebuy that same stock if you really wanted to get back in that stock if you felt like it was going to go up. Another tip is using TurboTax. They have a free, simple product where if you have some real basic tax returns, that you can use their product absolutely for free. And they'll make money on you later when you have a more complicated tax return. And this is really good for these days with COVID. There are less people available to do your taxes. Malls are not as open. So to summarize, plan to take advantage of the stimulus check. Think about if you should wait to file, if you've made more money and won't qualify, or if you should have qualified to claim that on your taxes, either through filing an amendment. Consider using the strategy to sell your personal residence after you've lived in it 2 of the last 5 to not pay any taxes on $250,000 or $500,000 of the sale of that property. Shoot for long-term capital gains when it comes to selling investment properties and stocks so you can take advantage of the most favorable tax rates. Start funding your Roth IRA today. Open one and commit to making regular payments and increase that as you can afford more and more over time. Make your risky stock investments in your taxable brokerage account so you can take advantage of any losses that you incur. If you don't make any losses, please let me know what you're investing in so I can follow you. Don't forget to hit the like button if you enjoyed this video, and be sure to put a comment below about any questions you have, and forward this to any friends that you think may find this information helpful. Thank you for watching, and I'll see you next time.
Although I am a licensed CPA and I have 3 business degrees, I'm just a guy on YouTube with my dog, so please consult your professionals before making any investment choices.